I think you are starting to see a movement in the gold price, and I think it's delayed. I don't care at all about the movement of gold from $2,000 to $2,150 or $2,200.
Right.
I own gold personally because I'm afraid it's going to go to $7,000 or $8,000. I've never seen a market where gold didn't have to establish the momentum and silver to fall in. Make no mistake, in my experience, and I've been through several bull markets, if the momentum gets established by silver, by gold, uh, silver will exceed all but the greediest of expectations.
Everyone seems to be pondering over just one question. What in the world is happening with gold? There is no denying that the current macroeconomic backdrop is fueling a perfect storm for gold, positioning the precious metal firmly on track for its biggest first quarter of the year ever since 1990. Gold has been on a parabolic run since October last year, surging from near the $1,800 level to score back-to-back record highs this month, not once, not twice, but on multiple occasions. Yesterday, gold prices ended with strong positivity, settling above the $2,100 barrier. This reinforces expectations of continuing the bullish trend on both intraday and short-term bases, with the approach towards the historical high at $2,200, which seems to be the next main target. Legendary commodities investor Rick Rule, the founder of Rule Investment Media, has always been bullish on gold prices, viewing it as a hedge against economic uncertainty. As an investor and speculator, Rick stresses that one shouldn't worry about small changes in the gold price because he foresees gold reaching unprecedented highs, potentially hitting $8,000. Several indicators are leading the price of gold up. One of the primary concerns observed by many analysts is the recent acceleration in the growth of the U.S. federal debt, now increasing at an alarming rate of about $1 trillion every 100 days. That's absolutely frightening. So far in March, we've added another $100 billion to the debt, so the rate has slowed to a projection of only a $4.3 trillion addition to the federal debt. This escalating debt situation raises concerns among investors and savers worldwide, including central banks. If this trend continues, it won't be long before the situation reaches a critical point. When that happens, owning gold becomes more desirable as a hedge against economic uncertainty. We will present clips from Rick Rule's interview with Wall Street Silver. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
I think you are starting to see a movement in the gold price, and I think it's delayed. I think the circumstances that are conducive to a move in the gold price have been around for 3 or 4 years. They're not new, but the response to the market is new. People's expectation of the future is set in the immediate, not the distant past, and not around history. We've been through 40 years of benign economic climate, ending, I believe, in 2022. And I think it's taken the market a while to react to negative real interest rates, to inflation, to debt and deficits. And I think it's that dawning realization, particularly among non-US centric central banks, to understand that gold is an important portfolio diversifier. And Ivan, I want to say right now that as an investor myself, as a speculator, I don't care at all about the movement of gold from $2,000 to $2,150 or $2,200.
Right.
I own gold personally because I'm afraid it's going to go to $7,000 or $8,000. The move that we've seen so far may be the end of the move. I don't know. That's not why I own gold. I don't own it as a trading sardine. I own it as an eating sardine.
Yeah, that's right.
And I really, truly do not own it because I think it might go to 2,500. So let's talk about that. Let's get that out of the way first of all.
Right.
The frustration around the silver speculators has occurred for as long as I have been on Earth. I don't know why. I have my suspicions, but momentum in a precious metals market is established by gold, perhaps because the fear buyer is more motivated than the greed buyer.
Right.
After gold has moved, then in the middle of a gold bull market, when the narrative has been established by gold, silver, perhaps because of its lower unit price, moves later. It moves further and it moves faster once it moved. But in every market that I've been around, except for the false breakout, the sort of Reddit precious metals breakout in 2020, when the speculative stocks led all the commodities, I've never seen a market where gold didn't have to establish the momentum and silver to fall in. Make no mistake, in my experience, and I've been through several bull markets, if the momentum gets established by silver, by gold, silver will exceed all but the greediest of expectations.
Right.
It'll just take a while. Now, let's go to the delta between the metal performance and the share price performance. First of all, this is consistent with all prior bull markets. The metals have to lead. It's important to know that when the metals lead, there's a lag. In the case of the gold price moving up from, say, a year ago at $1,850 to $2,150, what people need to understand is that although the gold prices moved up, the prices of the cost of producing gold has also moved up. So the margins haven't moved up in lockstep with the gold price. It's important to know that. If you look at the cash flow statements, the quarterly cash flow statements of major gold producers, although the gold price has moved up, it hasn't yet been reflected.
March 2024 is making investors nervous, with the cessation of the BTFP stirring concerns among analysts about potential banking turmoil in the aftermath. Launched on March 15, 2023, in response to the failures of regional banks such as Silvergate Bank and Signature Bank, the BTFP was designed to provide additional funding to eligible depository institutions. Rick highlights 3 significant challenges facing the banking industry in the United States. Firstly, there's concern surrounding commercial real estate, which poses a significant hurdle for banks. Secondly, there's an issue with banks lending for the long term while relying on short-term deposits, leading to interest rate mismatches that can eat into profits. Lastly, criticism is directed at the overly complex and inefficient structure of American banks, with many investors faulted for not fully grasping the intricacies of the banks they invest in. Rick emphasizes distinguishing between good and bad banks, suggesting that individuals should consider switching banks if dissatisfied with their current one. Let's get back to the interview.
I see more upheaval for commercial banking in the United States. By the way, I don't see the banking industry as a whole go away, but I see a tough time for taxpayers bailing out banks. I see an inconvenient time for borrowers going to banks that have traditionally supplied them with money because the banks are running out of money. I see at least three problems in banking. Commercial real estate, of course, looms large. The second is the time spread. Banks lending money long and funding that with overnight deposits.
Yeah.
When the interest rate goes up, of course, their cost of capital goes up, while the capitalized value of their loans goes down. That's why Bank of America has been having problems. But the third problem is probably the largest, which is to say the structure of the American banking industry has gotten very, very, very stupid. We're an overbranched country. I went into my bank branch a few weeks ago and asked the manager, very nice woman, by the way, about their deposit products. Turned out they had 15. And she didn't know enough about any of them to tell me. She pointed me to a white service telephone. That branch is costing the bank 140 basis points, 1.4%. And it isn't delivering anybody the value.
Right.
The second thing is that bankers try to be more things than they are. They try to lend to industries that they don't understand. The idea that Bank of America can bank 1,000 industries presumes that they know 1,000 industries well, presumes that they know the value of the collateral in those industries. Years ago, a community bank would lend to the industries present in that community, borrow from members of the community, and lend to members of the same community based on local knowledge. That isn't the way the banking business works anymore. We need to return to basic banking. And you, as a depositor, need to pay particular attention to your deposits. Did you know that of the 15 deposits that my financial supermarket proposed to offer me, 4 of them proposed to pay me no interest whatsoever? No interest whatsoever.
Well,
now,
what's the
whose
point?
possible interest could a banking product be in that purported to pay me no interest? And by the way, I'm a damn good customer.
Yeah.
You need to pay attention to that. The idea that they don't pay you interest on the free cash balance in your checking account
Yeah, it doesn't make sense. Why would you
is
put
an
your money
insanity.
there?
They're taking risk with it. They're getting paid. Why shouldn't you? most investors, I'm afraid, make the basic mistake of not understanding anything about the relationship they have with their bank. And most banking investors are as dumb as most mining investors. They don't understand enough about the basic business that they're investing in to make the investment. So once again, with banking, make your first investment in yourself. Get a statement of financial condition from your bank. If you're invested in banks, read the balance sheet.
Yeah.
Read the income statement. Learn something about the concentration of commercial loans. Learn something about their lending programs and whether they're lending to businesses that they understand. Learn in particular the spread between the duration on their loans and the duration on their deposits. That mismatch in assets and liabilities is precisely what brought down the savings and loan industry. It brought down Silicon Valley Bank. It brought down First Republic Bank.
The reality is that gold prices were already edging towards record highs, hovering around the $2,000 mark for quite some time, a level once deemed extraordinary. However, what truly grabs attention is the remarkable speed at which prices surged from their 2022 lows of $1,600 an ounce to the current record highs of nearly $2,200 an ounce. This unprecedented increase of over 60% in just 18 months signals a significant shift. This suggests a promising future for gold, with potential for further upward momentum and significant opportunities for investors in the precious metal market. Share your thoughts on Rick Rule's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.